Welcome everyone. So for those who haven't dealt with the Bank of England previously, or myself, the Bank of England has 12 regional and devolved nation offices around the UK. So I'm based in the office in Wales, and our role is primarily to go out and about. Well, pre-COVID times, it was jumping in the car, going to see businesses all over Wales, across all the different sectors. And we'd see about 500 businesses across Wales, and we'd have 12 offices doing this across the UK. So between us, we'd see 5,000 or 6,000 businesses, and we'd be providing up-to-date feedback from the coalface to the policy setters within the bank, so that when they come to set interest rates, they've got a much better understanding and feel for what's going on in the economy. Since COVID, we've adapted, so we now undertake some of that interaction via Teams or phone calls, but still, a decent chunk again by face-to-face visits. And as you can imagine, over the last few years, the intelligence that we provide has been, extremely helpful to Andrew Bailey and his colleagues, because we've faced such an uncertain and rapidly moving backdrop to the economic outlook. So what I'm going to do today is present to you the bank's latest forecast for the economy, which is called the Monetary Policy Report. These are produced every 3 months. So this is about a month old. Unfortunately, these days, as soon as you produce a forecast, things have literally changed the next day, particularly around energy prices and expectations there. But what I'll do is I'll present the forecast from a month ago, and then I'll try and update you, where things may have moved on a little bit as I'm talking you through the slides. So Siwan, if you can move on.
Yeah, of course.
To the next slide, please. So in terms of the outline of what I'll talk you through today, I'll start with the headlines, and then we'll move into what's been happening very briefly elsewhere outside the UK, and then we'll focus most of the presentation on what's been happening to and what might happen to growth in the UK economy. So we'll look at growth in the economy, then we'll focus on what's been happening in the labour market, because that's quite a topical issue when we chat to businesses, and the other hugely topical issue, inflation, before finishing off with another topical issue, interest rates and what might happen there. So if you could move on to the next slide. So in terms of the headlines, it won't surprise you to see that the first headline is all about the cost of energy, particularly gas. So further substantial increases in gas prices have dominated where we see the economy going in the short term. And obviously this forecast was put together just over a month ago. So we've seen, significant potential upward movements in gas costs. So as a result of that big uplift in energy costs, our expectation, as I said a month ago, was inflation would peak at just over 13% in the first quarter of next year. And that squeeze that will result on real household incomes would move the economy into recession starting from the fourth quarter of this year. But normally we provide a single individual forecast, but because of the huge uncertainties, particularly around energy costs, we've actually produced 3 forecasts this time. But what I'll do, I'll talk you through the baseline forecast to begin with, and then just show you a couple of other forecasts and how they vary from that baseline forecast. But in headline terms, whichever forecast I present to you, it doesn't change, the big headlines, which are, very high inflation and the economy moving into recession. So they don't change that, big picture, unfortunately. And even if energy prices only stabilize and don't come back down over the next couple of years, we're still expecting inflation to fall back from that peak, significantly, but obviously how far will depend on what happens to gas prices in particular. Siwan, if you could move on to the next slide, please.
Of course.
Thank you. So just finishing off the headlines, the outlook will also depend on the extent of the persistence in domestic wage and price setting, and there's been quite a bit of publicity, about this. How sticky is inflation going to be? So at the moment, we don't think it will prove sticky in that inflation will stay at these double-digit levels beyond the next 12 months. But there is obviously a risk of that happening if expectations around high inflation become more entrenched. So in terms of the labour market, we're expecting that to stay very tight this year, and that will continue to put upward pressure on wages. But we are expecting unemployment to start to increase from the middle of next year as the economy moves into recession. And we're expecting inflation expectations to fall back as that energy shock comes hopefully to an end. But as I said, if there is any stickiness around inflation, that could mean that it doesn't fall back as we're projecting in the baseline. So in terms of the headlines, what do they look like in numbers for the key economic variables? So if you look at GDP, we're expecting recession to start at the end of this year. So these are annual numbers in the first row. So they translate into a peak to trough decline in GDP of somewhere between 2 and 2.5% starting at the end of this year, and then each quarter next year showing a contraction. But even after that, we're not expecting a return to pre-COVID levels of growth. So very little growth in the last couple of years of this forecast. In the meantime, in annual growth space, inflation is going to be significant both through the remainder of this year, and it's going to stay high through most of next year. But then we are expecting inflation to fall away quite substantially in 2024 and 2025, because even if costs and prices stay high, but if they stay level, then that translates into weak inflation because they're not continuing to increase further at a significant rate. As a result of the economy moving into recession, we're expecting unemployment to start to rise from Q3 next year, and that continues to increase through the remainder of the forecast out to 2025 to over 6%, so just under double the current rate of unemployment. And that will coincide with the economy moving into a scenario where we've got some slack. So we'll have excess supply rather than demand in the economy building up over the next 3 years. And then the final row of that projection just shows you what markets are expecting to happen to interest rates in the UK. So these aren't the projections of the bank. The bank doesn't produce a projection for what will happen to a bank rate. And you can see there that markets are expecting interest rates, or they were expecting them a month ago, to peak at around 3%. And I'll come back to that one a little bit later, before then subsiding away a little bit to stay at around 2 to 2.5% over the last couple of years of the projection. And these baseline projections are based on a scenario where energy costs stay level after the first quarter of next year. So I'll come back to that one a little bit later. So if you can move on, thanks, Siwan. So this one doesn't assume energy costs stay where they are from Q1 23 onwards, that they actually follow the futures curve. And the futures curve, as I'll show you a bit later on, is expecting energy costs to come back down quite significantly from 2023 through to 2025. And that in this projection, we just show you what difference that makes to our headline projections that I just showed you in the previous slide. And as you can see, in the short term, it doesn't make any difference because we're only changing the assumption around energy costs from the first quarter of next year. But if energy costs do follow that futures curve down, then it means that we're expecting a shallower recession. So you can see there in the Q3 23 column, GDP declines a little bit less than in the baseline. And we also have a lower number for CPI inflation compared to the baseline. And we have lower unemployment compared to the baseline as well, because that upward pressure from higher energy costs is less pronounced. If you can move on to the next slide, Shuan. And then finally, and apologies for giving you, 3 projections, but as I said earlier on, the headline isn't any different under all 3 of them, where we're kind of playing around the edges of what will happen, as opposed to fundamentally changing our forecast. You can see in a scenario where there's more persistent inflation, inflation is a bit stickier than we're expecting in the baseline. Inflation is a little bit higher than we're expecting in the baseline projection, and GDP contraction is a little bit more pronounced as a result. But the main impacts are over probably the first couple of years of the projection, as opposed to later on when the numbers aren't that different. If you can move on to the next slide. So I'll move on to very quickly just cover what's been happening elsewhere in the world in aggregate. So this is showing you what's been happening to global GDP growth. And what we do here is weighted by how much we trade with that part of the world. So the euro area is around 40% of this global bucket. And then the US is another decent chunk of that bucket. And you can see, if you look at that turquoise line, you can see that global GDP growth has contracted or slowed down from around 5.5% to around 2.5%. And you need to look at the left-hand axis for the scale for this one, rather than the right-hand axis, which is in quarterly numbers. So we're expecting growth to slow down from 5.5% to around 2.5%, and then further slow down to around 1 to 1.5% in those turquoise diamonds. We're expecting the euro area to move into recession, as well as the UK in 2023. But again, this forecast was produced just over a month ago. And since then, we've had the news that, the Nord Stream gas pipeline from Russia to Europe is going to stay offline indefinitely. And there are worries about what that might do to the European economy, particularly the German economy, over the coming months. So those, that news isn't built into this projection currently, but it will be built in to our next projection in November. And obviously the risk is also around what might happen in terms of the Russia-Ukraine conflict, but also in terms of COVID, if there are further lockdowns in China, for example, impacting global supply chains. If you can move on to the next slide, Shuan. So supply chain constraints have been, very marked over the last, number of years, and indicators are that, that we will continue to see disruption, although there are some signs of supply constraints in China easing a little bit, and you can see that in that orange line just coming down over the last few months. But that turquoise line is showing that compared to what we would have seen in the past pre-COVID, supply constraints are still quite elevated. And for example, when we chat to people in the automotive and aerospace sectors, the semiconductor shortage is expected to remain an issue. Sorry, I've managed to set my Alexa off. Hold on a sec. Alexa, off. The joys of modern life. So now I've turned Alexa off. If you can move on to the next slide, Shuan. As a result of the slowdown that we've started to see in the UK recently, and the fact that the US has been starting to raise interest rates aggressively, the pound has fallen a few percentage points since our last forecast in May, and indeed it's fallen a little bit further since we produced this. Yeah, apologies for turning someone else's Alexa on. Oh no, I've probably turned everyone's on now, but I won't mention that word again. So sterling has depreciated a little bit more since we produced this forecast, and that's not good news if you're importing, because a lot of those costs can be dollar denominated. So that's probably adding a little bit to input cost inflation. Unfortunately, it's not particularly helping exports as far as we're aware currently, because that's usually the good news from a depreciation. It helps exports a little bit, but we're not seeing that quite yet. If you can move on to the next slide, and then the next one again, Shuan. So enough of the global economy. Let's turn towards the UK. And what we try and do in this chart is kind of strip out the unusual things that have been going on in the UK economy through the second quarter, in particular. So the turquoise diamonds are showing you what the ONS has published as the GDP growth number for the last 4 quarters, and you can see there that it showed contraction in the second quarter. And we're expecting that to turn around into a positive number in the third quarter, but that's mainly because you'll see in the orange and yellow bars we saw a significant impact from partly from the extra bank holiday for the Jubilee in the second quarter. That feels like a long time ago now. But the main impact was the ending of the track and trace program that sits within government output. So the ending of that program will actually have had a significant impact on economic activity across the economy. So what we've tried to do here is strip out those effects. And if you look at the purple bars, they point to what we think is happening to underlying growth if you strip those funnies out. And you can see there that we have seen underlying growth also slowing down, but not to the degree that we saw in the published numbers. So growth halved in the second quarter from the first quarter to around 0.5%. And we're expecting that third quarter to still be slightly positive, but nevertheless, it's going to be quite marginal growth of around 0.1% in the third quarter that comes to an end at the end of September. If you can move on to the next slide, please. And chatting to businesses, and these are surveys that are produced by other bodies such as SIPS, the chats to purchasing managers. Anything above 50 indicates growth. Anything below 50 normally points to contraction. You can see those output and new order lines were already getting pretty close to that 50 dividing line. The future output indicator was still pretty positive, but we suspect that if you did this survey today, those lines would have moved much closer to the 50 mark, and indeed they may have already moved below the 50 mark, indicating contraction. If you can move on to the next, and I think this is a slide where we build up the chart. So this just shows you what's been happening to nominal household incomes. So this is before the effect of inflation, and you can see there, we've seen wage growth picking up. So on the face of it, this is, quite a positive chart, but unfortunately, when we add in what's happening and what will happen because of inflation in the orange bars, and then net that off. So if you can just add the next line in, Siwan. So this shows you the net effect. Oh, sorry, can you just go back to the, that's it, thanks, Siwan. If the white line and the white diamond show you the net effect of basically the positive growth in income, but the negative effect of what inflation is taking away from that. So by the end of this year, real incomes for households will be falling by around 2%. But then as we move into 2023, that peak in inflation that we're forecasting at the start of next year is actually going to reduce real incomes by around 5%. And that'll be the biggest contraction that we've seen in decades, even bigger than what we were seeing in the 1970s when we had that energy price shock. So a huge squeeze on real incomes already starting, and unfortunately is going to worsen. And if you move on to the next slide, Siwan, and then if you click the next one again, so a survey of consumers ask them, well, how are you going to respond, or how are you responding to, you know, a squeeze on your incomes? And you can see here that, you know, the main responses indicate that people are going to look to spend less rather than use more credit or use their savings. So to begin with, they're going to try and spend less on non-essentials, but they're also going to try and cut back on use of fuel in the home. And they're also going to have to look at, you know, the essentials as well. So spend a bit less on food shopping, shop around more. And you can already see this, you know, in the feedback from supermarkets, that the discounters are already gaining market share at the expense of the, you know, the mid-market players and the upper end players. And we're also seeing you know, individuals having to look closely at, you know, all of their discretionary spend as well. So a real squeeze and response accordingly from consumers. If you can move on to the next slide, Siwan. So as I mentioned, as a result of that squeeze on household incomes particularly, we're expecting the economy to move into a recession starting from the fourth quarter of this year, when, you know, we really see those energy bills and use of energy spiking up. So the fourth quarter of this year, we're expecting the economy to contract by just under 1%. And then each quarter of next year will also show contraction. So this shows the annual GDP growth forecast as opposed to the quarterly numbers. But you can see even in 2024 and 2025 that we're expecting the economy to show little or no growth. So by the end of, or almost the end of 2025, the economy will still be a little bit smaller than it was at the end of 2019 when we were entered, you know, the COVID lockdowns. So in the reality is we'll have had 6 years where the economy won't have grown over that space of time. And normally the economy in the UK would grow between 2 and 3% a year. So, you know, we'll have probably lost around 15% of growth in the economy over that 6-year period. If you can move on to the next slide, and then the next one again. So we'll move on to look at the labour market. And this has been a really topical issue when we've been chatting to businesses over the last couple of years. So normally the supply of labour in the UK grows year on year because we have population growth alongside, you know, fairly static participation by the population in the labour market. But if you move on to include, and that's it. But what's been really unusual over the last couple of years is we've seen a marked decline in participation in the economy. So, for example, you know, we've seen a lot of people move out of the labour market for varying reasons, and I'll come on to that in the following slide. On the demand for labour side, if you can click again, Siwan. So you can see in the orange bars, when we went into COVID lockdown, there was a huge decline in the demand for labour, but that's really turned around as the economy started to open up. And as you'll have probably seen and read or experienced, there's been, record numbers of vacancies across the UK economy. And if you click again, Siwan, there's been, growth in employment as well. And if you look at where that white line in labour demand is compared to the white line on labour supply, there's a 500,000 gap between those lines, and that's a reason why the labour market feels so tight currently. And if we look at the labour supply on the next slide, Siwan, thanks. There's been a marked increase in long-term sickness. So you can see the green bars in this slide showing, a rise of around, 300,000 in those declaring themselves long-term sick. And that's been a big driver of the decline in participation. And when we're chatting to businesses at the moment, they have wondered whether we will see, some return, for example, from long-term sickness, or those that have taken early retirement over the last 12 to 18 months. We're not seeing that yet, but I think there is some, there is some talk about with the, energy bills rising in coming months, whether that will, force a return of some of those individuals back into the labour market to try and meet, those rising costs. If you can move on to the next slide. But no doubt at the moment it's extremely difficult to both retain and recruit staff, and that's because of increased demand for labour across the economy, and that's leading to higher wages being offered elsewhere. So there's been quite a lot of poaching of individuals, individuals jumping ship. Employees have reviewed their lifestyle preferences. So some, for example, have decided to take, as I mentioned, early retirement through the COVID period, or decided to have a change of career. And we've also had Brexit reducing the availability of EU workers as well. There's just signs at the moment that increase in demand for labour is starting to level off. So business feedback is that maybe firms are now looking to stand still in terms of headcount as opposed to increasing their headcount, and employees maybe just starting to think twice about jumping ship because they can see there's uncertainty coming down the line, which may mean that they'd rather stay where they are, maybe to a slightly larger degree than they were even a few months ago. If you can move on to the next slide. Thanks, Siwan. So this is just showing you what's been happening to wage settlements. So normally when we review and ask businesses for their expectations for pay, they've normally run around between 2% and 3%. But this year, when we asked businesses back in January, they were expecting that to rise to 5%. And looking ahead over the next 12 months, they're expecting that to increase further to just under 6%. And I think there is a risk at the moment that number could come under further pressure with the numbers that we're hearing about for gas costs and expected, peaks in inflation of anywhere between 13%, the number that we were expecting a month ago. We've seen numbers from Goldman Sachs and Citibank of 18 to 22% in the first quarter of next year. But set against that, businesses are also saying to us, they have to be able to afford these increases. So that will, push back on some of those wage demands from employees. So we'll have to see how those, net off in terms of where awards end up. If you can move on, Shiwan. Yeah, we're going to skip that one. If you can move on to the next slide. So as I mentioned earlier on, we are expecting unemployment to start to increase, but we don't think that's going to start to happen until maybe the middle of next year. Businesses are saying to us at the moment that, because they found it so difficult to both recruit and retain staff over recent months, they'll be loath to release permanent staff quickly. I think they'll try and hang on to their permanent staff as long as they can. So to begin with, if they have to, look at their cost base, they may cut back on investment to begin with. They will then look at, the hours they provide to staff and maybe cut back on hours and shift patterns. They will then release contractors or temporary staff. And then as a final, as a last straw, they will look to reduce permanent headcount. So that might not happen until the middle of next year as the economy is slowing down. And as you can see there, we're expecting unemployment to rise from just under 4% to just over 6% over the next 3 years. So moving on to, probably the most topical issue at present, which is inflation. If you can move on to the next slide. So between our May and August forecasts, you can see there that turquoise line showing the gas futures price by the end of this year had nearly doubled just in 3 months to over 300 pence per therm. If you move on to the next, sorry, and the next one again, Shuan. Sorry, this is the futures curve that I was talking about. So that orange line, oh, sorry, Shuan, can you move back? Thank you. That orange line is almost double the level of the purple line. So what we've done in our baseline projection that I mentioned earlier on is as that orange line comes back down to just over 300 pence a therm in the first quarter of 2023, we've held that 327 pence per therm point at the end of Q1 23. We've held that stable, and that's what we would always do in these forecasts. We take the first 6 months of the futures curve and then we hold it, because we tend to think futures curves don't actually they're not very good predictors of what might happen beyond the first 6 months. But if we did assume that futures curve, then you can see gas costs are, well, in August, they were expected to return towards 100 pence per therm, which looks, relatively good news. But if you take it, compare it to where we were between 2019 and 2020, gas prices normally would be around, 30 to 50 pence per therm. So it's still, significantly higher than we would have seen over the last few years, and indeed over the last 10 to 20 years. So if you move on to the next slide, Shuan. So we're comparing here the direct contribution of energy prices to inflation over the last 12 months of our forecasts. So you can see that turquoise line is showing that the direct contribution of energy cost to inflation will have risen over that time frame since the end of last year, from around 1 percentage point to over 6 percentage points. And even if we take that futures curve that shows energy costs reducing more quickly over the next couple of years, it doesn't alter that short-term scenario of this this significant contribution to inflation. And even after that, it's only knocking about 1 percentage point off our inflation projection moving ahead. So if you go on to the next slide, Shuan. So you can see the significant contribution of electricity and gas is only 3% of the basket of inflation normally. but that just the electricity and gas part of the basket is going to add around 6 percentage points to inflation over the coming months. And if you click a couple more times, Siwan, until we see the white line for inflation overall. There, if you stop there, so you can see that electricity and gas is going to be contributing around half of that 13% peak in inflation. But I should mention, those Citibank and Goldman Sachs expectations that have been produced on updated gas futures curves since we produced this forecast a month ago. So we're expecting, around 13%. They are calling numbers of 18 to 22%. So there's a huge variation in expectations. And I think it's fair to say those expectations are changing very rapidly on a daily basis, unfortunately, at present. If you move on to the next slide, I mean, there has been a little bit of good news in that there's been some easing in global commodity prices in both industrial metals, oil, and agricultural goods. But that's been far outweighed, unfortunately, by all the news on energy costs in terms of gas over the last few months. If you move on to the next slide, Siwan. So we've got inflation peaking at around 13%, and even in a year's time, inflation, we're still expecting it, or we were still expecting it in August to be around 10% in a year's time. But then we are expecting inflation to subside away back to below 2% in 2 to 3 years' time as the economy moves into recession. So that the push from demand subsides, and we'll also see, or we're expecting to see, no further increases in energy costs, pushing up further on inflation. If you can move on to the next slide, and then the next one. So in recent times, if you move back, Siwan, just stay on that one briefly. So we've moved from the all-time record lows for interest rates of 0.1%. The committee has increased interest rates consecutively over the last 6 meetings to 1.75%. And if you move on to the next slide, and a couple of big factors there have been, the tightness in the labour market and this, increase in inflation with the risk of what we call second round effect. And that's basically talking to pay awards. So as we move into January to April of 2023, inflation will be peaking, in our view, around then at 13%. And that's when a lot of pay awards take place. So there is the risk that, pay awards move beyond that 5 to 6% expectation that we have in the forecast. That will then feed into potentially, stronger demand across the economy, because there will be more money going into people's pockets. So we might not see the contraction that we've forecast in household spending to the extent that's in the forecast. So there'll be a risk of what we call further second round effects. But the committee have said, look, moving forward, markets are expecting us to move interest rates to 3, maybe 3.5%. There's even been some talk of 4% as a peak in bank rate. The banker said, look, we're going to review our decision each and every time we meet. Policy isn't on a preset path. So the scale, pace, and timing of any further changes will reflect our assessment of the outlook, at the time of each meeting. But they are going to be particularly alert to any indications of more persistent inflationary pressure. So, the banker said, look, we know it's painful, but if we need to increase interest rates further, to ensure that inflation expectations don't become entrenched at that, at these higher levels of current inflation, or where we expect inflation to peak at, then that's something that we will do if necessary to ensure that we do return inflation to the target of 2% in 2 to 3 years' time. And then just finally, if you move on to the last slide, you'll all be aware as well that the bank has undertaken what it calls an asset purchase program since the global financial crisis, where we've been mainly buying government gilts to the tune of around, currently just over £900 billion. The bank has been reviewing, when it might start to unwind that purchase program and start to sell off some of these assets, particularly government gilts. At the moment, the view is that they will start to do that after their September meeting at a pace of around £80 billion a year, but they will review that after, at their September meeting, just to make sure that economic and market conditions are appropriate before they commence on that sell-off. And then this just shows you where markets were expecting interest rates to move, both in the UK and the US and the euro area over the next 3 years. So the solid line shows expectations as at the first week of August, and compares them to where they were in May, 3 months previously. And you can see those solid lines have moved up compared to the dotted lines. So in the UK, they're expected to move to around 3%. In the US, a little bit higher than that, and somewhere between 1 and 1.5% in the euro area. And I should say that our forecasts do assume these market rate expectations. So sitting behind this growth forecast is an assumption that interest rates move according to these market rate curves, rather than rates standing still. But even if we showed you the projection for the economy with base rate or bank rate staying still, where it is now at 1.75%, unfortunately, that we still think that would lead to a recession in the UK, and it wouldn't alter that peak in inflation of 13%. So unfortunately, it doesn't change the big picture that I've outlined over this presentation. So you'd be pleased to know that's the end of my forecast. Just one last slide, which is to remind people that the paper £20 and £50 notes are to be withdrawn on the last day of September, the 30th of September. So that's the last day they can be used as legal tender in shops or to pay businesses. And I guess as a reminder, a lot of us have elderly relatives who, may be are more reliant on cash than we are. And also, if you've got younger children, that they may, still have cash in their piggy banks. It's worth just checking that they haven't got any of the old paper notes. If they have, try and make sure that they hand exchange those or use them before the end of September, before they aren't legal tender anymore. We will accept them at the head office of the Bank of England in Threadneedle Street, but obviously that's a bit of a pain to have to go to London to exchange those notes. So I'm happy now to take any questions or comments that individuals might have placed into the chat box, Siwan, or just
we've got it up. I think obviously thank you ever so much, Ian. Massively grateful for obviously your presentation. I just wanted to just quickly run a last minute, I suppose, call for any questions in the chat. First and foremost, we do have one question that has come in. Obviously, today has been a briefing to the Accelerated Growth Programme entrepreneurs, and of course, the entrepreneurs on the programme represent business owners across Wales, some obviously of small business owners, SMEs, you could argue. They are natural problem solvers, and they react obviously more rapidly with sort of quite an honourable amount of resilience. One of the entrepreneurs in the chat has asked, with this in mind, ignoring any policy changes that the Bank of England does or the UK Welsh Government do, we might be able to, as business people, help avoid inflation, avoid unemployment, and make things more positive. Any sort of, I suppose, suggestions, in terms of what can we do? I think this is where this question's going. What can we do, I suppose, in order to make the best of a sort of quite a difficult situation?
Oh, that's a really tough question to answer, I think, in the current climate. Obviously, we're expecting news from the new Prime Minister quite soon in terms of support that the government might be able to provide, potentially both to individuals and to businesses, and how they might approach, this shock that we've seen in energy costs. I guess in terms of, you're quite right that smaller businesses have to, by their very nature, be very resilient in terms of their outlook. They have to respond very quickly to changes in economic circumstances. I think, as I said, our expectation is that inflation will return to target of 2% over the next couple of years. I think what's going to be tough for businesses is trying to manage how much of this cost inflation they feel able to pass through to their customers. And I think this is one that businesses are already, having, they're providing feedback to us that they're, so far, I think they have felt able to pass on, a decent proportion of those additional costs, whether they're coming from, materials or labor. Sometimes, it's, if you're in manufacturing, for example, or you're a wholesaler, it can be easier to pass on the cost of goods than it can be to pass on the cost of labor. I think where businesses are they're puzzling about at the moment is, what are they going to be able to do in terms of those higher energy costs? I think there's an expectation that the size of these energy cost increases and SMEs aren't going to benefit from these caps that are available to households on energy costs. I think there's a worry that the energy bill is going to go up so significantly that they're going to have to pass on a decent chunk of that extra cost. But that's in a climate where demand, in our expectation, is going to be moving into negative territory. The demand is going to be starting to ease. So I think it's a real it's going to be difficult to know how much of that those extra costs you're able to pass on. And our expectation is that businesses will pass on some of it. But we're all effectively going to have to take some of that pain. So I think businesses' profit margins are going to suffer because they're not going to be able to pass on all of those extra costs. So the workforce will probably have to take a hit in terms of their real incomes, because they can't be, businesses aren't going to be able to afford to offset all of that extra inflation into wages. But they're also not going to be able to pass it all into the prices to their customers as well. So I think, unfortunately, we're all going to have to kind of share in some of that pain. But I know it's a tough one to take on, but I know the bank has been trying to say to people, look, if we are able to contain inflation as much as we can by limiting what we pass on in terms of prices and how much we raising wages by, in the long term, that will prove beneficial to the economy as a whole. Because if we can, I think in the past, when inflation's at 2%, people maybe have thought, oh, well, we don't have to worry about inflation. It's always going to be, quite low and modest. And but I think what this episode is proving is how painful high inflation is. And
actually is, yeah.
I think it's probably making people really think hard again about, the damage that high inflation can cause, particularly to those on lower incomes. So if we can all work together to try and make sure inflation doesn't stay high for longer, then that'll be good news for the economy as a whole.
Yeah. Thank you for that. That's brilliant. Thank you. Any more questions in the chat before we draw the webinar to a close? We've got 1 minute remaining of Ian's time.
I'm conscious of people's time.
Okay, yeah, I think we'll leave it there, in which case, thank you ever so much for attending. And again, thank you ever so much for coming along, Ian, as well, and presenting this. We are going to be hopefully getting somewhat of a regular update from the Bank of England, as I think this information, forgive me if I'm wrong, again, can help to provide some sort of good, valuable insight to you as business leaders in order to sort of make some key decisions. So the plan is very much for us to sort of keep in touch with the Bank of England to get these updates more regularly than before. But until then, thank you ever so much indeed for attending, and yeah, we shall see you soon. Thanks a lot.
Thanks, everyone. Bye.
Bye-bye. Bye-bye.